Welcome to LevelUp Co-ops. In this session, we explore internal capital accounts, the financial tool that keeps worker co-ops strong, fair, and growing. So, what exactly are internal capital accounts, or ICAs? Christie explains how they transform traditional ideas of ownership into something collective and equitable.
When I say the word shareholder, right, a regular person probably thinks about some shadowy anonymous investor, a business who has a stake in a company. And so how much they control the company generally depends on how much they've invested, and they are most probably, almost certainly, not actual workers in the business. On the other hand, as we all live and breathe in this much better world, in a worker co-op, only workers can be shareholders in the co-op, right? And everyone's contribution is equal. So instead of money controlling labor in a co-op, we have workers who are equal shareholders in the business, and everyone has one share. So as I said, membership shares can only be held by workers, right? Can folks tell me what are some other rules or conditions with membership shares that you have as a co-op member? Only one share per person. Thank you so much, Nayatara. Membership shares cannot be sold or passed. The value does not increase. Yay. And the one that we're kind of like sitting on today is right. Like these shares give you the right to internal capital accounts. Another component of this system is the tax rules, right? So subchapter T, as you all know, is the tax code that governs co-ops. Internal capital accounts kind of interact with the tax code. And so we'll get into the details of that later. But the important thing to know is that it just helps you, it allows the business to maintain two things, the collective account and also the internal capital account.
In simple terms, ICAs show how much value each member has built in the co-op, without letting the cost of membership rise over time.
There are kind of two components to this, which you all probably know, the collective account and also the internal capital account. Why does this matter? Internal capital accounts are really important because firstly, they are part of that mechanism that helps keep your membership shares at the same price, as Sarah answered in the chat earlier. So no matter when you buy in, that membership share is fixed at the same price, right? So in a normal business, like I'm thinking about like an Apple share, right? The last time I checked last week, the share was like $240 something dollars and 50 cents, like really precisely. Right now, today on Wednesday at 12:20 p.m., it's probably not that dollar value anymore. That's because those shares represent the net worth of the business, right? They rise and fall with how valuable the business is. But in a co-op, we have this really nifty thing where the net worth of the business is actually held in the internal capital accounts, right? They're not a cash account, they're not a bank account. It moves the value of the business away from the shares, and they're fixed at that membership buy-in fee. So make sure that the co-op does not get too expensive as it becomes more successful, and it does not prevent it from admitting new members that might not be able to afford the share price.
Christie breaks ICAs into three core decisions, or levers, that every co-op can adjust depending on its needs.
So the way that I've broken down how to learn about ICAs is to think about the kind of three central questions at the center of this process. I've called them levers. You can look out for this little toggle icon for an easy way to see them. But these are the questions that you should learn on how to consider and evaluate your answer to these questions that will then allow you to make better decisions about internal capital accounts.
To make this real, Christie walks us through co-op cleaners, a fictional worker-owned business deciding what to do with their year-end profit.
So let's introduce co-op cleaners, a fictional business. Let's assume they have 10 employees, and for easy, very, very easy math, they have 5 members and 5 non-members. So half of their workforce are members of the co-op and half aren't. And then let's say they made a net income of $50,000 before taxes. So let's say it's the end of the fiscal year, you've closed your books, and we're simulating kind of going through the process of internal capital accounts with this $50,000. The first step is to determine member patronage income. In simple terms, that's the amount available to profit share with members. Because this co-op has both members and non-members, it's important to note that only profit that is generated by members can be distributed as patronage to those members. So the first thing you need to do is just identify, which slice of the pie goes where. It's very easy in this case. As I said, half of your employees are members, and so 50% of this 50K just automatically gets sent to the collective account because it was generated by non-members. And that leaves $25,000 to kind of distribute to members as patronage, potential patronage. So we're still here. We're around this $25,000 profit generated by members. And what do we do with that pot of money? So the next step is to decide how much of that $25,000, how much of that member generated income can go to the collective account. So this $25,000 is the maximum amount that you can profit share with members, right? But the other place that this net income can be stored or can go is in the collective account. In other words, kind of the company's reserves on the balance sheet. This is the first lever. This is the first question, right? How much should be paid out to members versus kept as reserves in the collective account? Generally speaking, this question is kind of answered by the board. Maybe members will have a view on it. And it might be a set percentage in bylaws, or maybe it's flexible year to year. But kind of the meat of it is like, how do I actually answer this question? The short of it is it's really important to understand your business's priorities. So this first column on the left. Understanding your priorities means like balancing what is fair for current members, but also balancing what the business might need in the future, or to keep the business strong by keeping some funds in reserves. And it's also important to remember that any money that gets retained in the collective account is also taxed at the corporate level of 21%. Okay, so let's just go through like these three different priorities that you might have. So let's say that you're a business and you're saying, I want to prioritize sustainable business growth right now. I want to grow the business. I want to go full send, like let's keep growing. You might then say, I'm going to put more of the net income into the collective account. I'm going to retain it in the business's reserves, so that it can be reinvested and fuel growth. And that money, that like those funds in the reserves, can be used to buy things like better equipment. It can do asset upgrades. You can hire more employees, kind of just bolster the business's current operations. But because that money is allocated to the collective account, it's taxed still as at the corporate level. So that's just one thing to note, that you might have a higher tax obligation if you allocate it to the collective account. The second priority maybe is actually right now I want to reward our members, right? I want to make sure that they have regular cash payouts, that members are happy and feel like they have a share in profits. And so you might say, okay, actually this year I'm going to, allocate a bit more to members. Most co-ops actually are generally more inclined to distribute the profits that they have to members. It can be hard to see the immediate incentive to choose to retain them in collective account. You might feel like you're kind of taking them away from members, and you just want to provide kind of like immediate benefit to the workers. And I understand that. I can understand that because I think at the moment, the average income of co-ops in the US is only like 30,000, like net income is only $30,000. And so it's easy to understand why a co-op might want to put its membership first with that limited pot of money, instead of kind of thinking of the future. But again, this means that there's less money left to strengthen the balance sheet. Finally, there's this last one, which is like maybe a bit of a middle ground between priorities one and two, is finding a balance between two. Like you can probably do both. You can help both the members and leave a little bit to invest in the business in the long run. And so the co-op can use something called a written notice of allocation, WNA. I'll be calling it WNA later, which works like an IOU, basically. So instead of paying all the patronage allocated to members right away in cash, the business promises to pay back part of it later. This amount that is like owed to the member is held in your individual internal capital accounts and can be used by the business in the meantime.
This exercise shows how co-ops balance fairness to members with keeping the organization financially resilient.
Okay, so I've shared some information on like how you might answer this question. How much should be paid out to members versus kept as reserves? So let's kind of trial that out with like a model scenario. So what would you do? Let's say this is your co-op. Your co-op has had a few years of positive net income. It wants to expand and upgrade some equipment and software. Based on what I just shared, that table, and I can go back to that, what would you do? You probably might want to allocate more to the collective account, right? Let's say it's like a 60-40 split just to kind of hedge and make sure that you have enough money in the business to be able to upgrade your equipment and software. Let's say you have a slightly different scenario where your co-op has made more in profits. It's still early days for the business and the worker owners have never received bonuses. What would you do? It's a trick question where like either way is fine, right? You could make the argument for either way. You know, you could say, I'm going to put more to the collective account, right? It's early days, want to hedge, just keep more in the reserves, not be distracted by 1 year of better results to ensure future growth. Or you could distribute it as patronage and reward those worker owners for a good year. So just returning to the process, kind of coming back to co-op cleaners, let's just say of that $25,000, they decided to split it 60-40 with slightly more to patronage to members and the rest going to the collective account. So $15,000 is able to be allocated as patronage for members. Let's move to the next step, step 3. So the next step is to decide of that $15,000, how much do we pay out in cash versus equity? And now we have written notices of allocation again, which I believe John had already kind of used it in one of his answers to the scenario. This situation is another lever. So how much are you deciding to pay out in cash immediately and how much should be retained as equity? So let's dive into WNAs for a second.
Next comes one of the most important and misunderstood concepts, the Written Notice of Allocation, or WNA.
Cool, so what are those? WNAs, as I mentioned earlier, is like a form of IOU. It's saying, okay, I'm gonna allocate you patronage, but a portion of it, I'm not gonna pay out in cash immediately. I'm gonna retain in the business, but that is still owed to you. It's still your member equity. Any of that patronage that doesn't get paid out in cash is retained and kind of reinvested in the business, like Carla said in the chat. A simple way to think of it is that retaining more in the business helps strengthen the balance sheet, right? There's more equity, there's more flexibility for the business. These WNAs do need to be paid out eventually, right? They're not kind of under the co-op's ownership now. They're still kind of technically the members' share. And so even though a co-op might have a high net income in 1 year, it doesn't mean it always has enough cash on hand. And so some expenses like loan payments or like big equipment upgrades don't show up in net income. So it's really important to plan carefully and plan for your cash obligations. So using WNAs in this instance lets the co-op reinvest that net income while still giving members credit for their share. And so Mariana asked, do the WNAs get taxed, right? I'm going to get to it in the next slide, but the the short answer is yes, they do get taxed, but with an asterisk. That's because most co-ops, when they pay out a patronage dividend in cash, you're required to pay out a minimum of that total patronage dividend, regardless of how much you're retaining in cash and retaining in equity. Of that total patronage dividend, you have to pay out at least 20% to the member immediately. And that is because this 20% assumes that the member will have enough with that extra 20% to pay for any tax obligations right now. And so if the WNA does pay out 20% of the patronage dividend immediately, these are actually specifically called qualified written notices of allocation. If you don't meet that 20% threshold, they're unqualified, but they're very rarely used in kind of standard worker co-ops. But it's just to be very precise in language, qualified WNAs pay out a minimum of 20% in cash.
Think of it as a promise. Part of your earnings are reinvested in the co-op for growth, but they still belong to you.
What would you do? Your co-op has grown a lot in the last 2 years with lots of new members joining. This is partially to anticipate some of the original founders retiring soon. The co-op's profits remain stable. What would you do?
The best part of Level Up is hearing members think out loud. Here's one of those moments when a participant challenges how taxes work in co-ops, and Christie responds.
Hi, thank you for this. I love this topic. So, in the what would you do question, I'm thinking that individual members might very well have a lower tax rate than the 21%. So, we could, as a co-op, we could find out if they do have a lower tax rate. And wouldn't it be more tax efficient to allocate the money to them, and then the portion that is a written notice of allocation that is kept in the co-ops, inside of the co-op, could still be used for the things that we need to build the business, but it would be taxed at a lower rate. So wouldn't that be always the thing to do?
Yeah, good question. That is one approach with like a very like if you're thinking very precisely and very carefully about like different tax rates, especially if you know all the like individual tax rates of all the individual members. If you find out that those individual tax rates are lower than kind of the overall co-op tax rate of 21%, yeah, it would always make sense to go kind of to the individual tax rate. It's hard in the purposes of this presentation to kind of like model that out with loads of different members. But yeah, in the scenario that does happen, you probably would do that. The kind of like tricky tax thing is that with the flat corporate tax rate of 21% and with qualified written notices of allocation, you already have to pay out 20% of the patronage dividend to the members in cash immediately. So kind of the savings is like, it's like basically effectively the same amount of money. So with this like new world that we live in of like the flat corporate tax rate and not a progressive corporate tax model, it's like less easy to be like there's an overwhelming like reason to why you might allocate to the individuals. But yeah, that is a fair point. If we had a progressive corporate tax system, allocating to individuals who you can assume might have a lower tax rate would be what you would do. So coming back to the scenario, sorry, I've gone in a little bit of a couple of directions. So let me just like recenter the scenario. Again, like I think people can make the case either way. So you might say that you might retain more of it as equity through qualified written notices of allocations because of this kind of sentence at the end. Some of the original founders might be retiring, and so you just might want to anticipate some of their WNAs that are being paid out soon and make sure that you have enough cash on hand to pay them. Let's say co-op cleaners, let's go back to them. We haven't forgot about them. Let's say that they decide to do 30% of their of those patronage distributions paid out immediately in cash to members, and then 70% retained as equity. Because this 30% is bigger than 20%, right? These WNAs would be called qualified written notices of allocation. The very last step, which is like the easiest step in this presentation, is you just have to calculate the individual shares owed to members. And so for simplicity's sake, we had 5 members. Let's assume that they all worked exactly the equal hours. You would just divide all of these shares equally by 5.
Toward the end, Christie offers grounded advice on managing WNAs over time, balancing sustainability with fairness.
We have the last lever, and Mike asked about this, right? So how long should WNAs be retained for? That period of time that you retain WNAs can be decided. It's flexible. It's not something that's defined by the tax law. It's not something that is defined in your bylaws necessarily. You can make that decision every year. Even though this unpaid patronage amount is like tracked in each member's internal capital account, that actual money is like not separated in like separated components, and that money is pooled together with all the other members' balances and any other retained net income. So any other non-member income, any other like ancillary income that you decided to put in the collective account. Because it's not managed separately, it means that the co-op will need to manage its money very wisely to make sure that it can still pay everybody those IOUs whenever you said that you would pay them. And so there's a case for saying you should keep WNAs generally for a slightly longer period. I wouldn't recommend kind of setting it with a 1 year or even a 2-year payout period. And there are a couple of reasons for why that is helpful. Remember, any retained income is used to strengthen the balance sheet. It gives the business more equity. It gives the co-op more money to reinvest in the business. And so the longer that you have those retained funds, the more reinvestment you can make ideally. It's very useful to cover big business expenses like paying wages, buying equipment, or if you have like continuous like annual or biannual capital expenses. It can also be used for hiring or training new members. So it's like a very effective thing to use. And the last thing, which kind of answers your question, Julie, is like you could also set the payout period to be exit, to be retirement. Loads of co-ops do this. They say this money is just going to be owed to you and you'll get it back when you retire, when you redeem your shares. And that includes your initial buy-in fee.
Flexibility is key. Each co-op can decide what fits its members and financial rhythm best.
This is just to say you did it. That's like what allocating a net income through internal capital accounts looks like. There's 4 steps, there's 3 levers, that's it.
To learn more or join our next LevelUp Co-ops workshop, visit icagroup.org/events. Because when workers own the business, we all grow together.